Hello, my name is Jingonelli, and today we are going to be looking at preparation of books of accounts. But before I begin off, make sure you subscribe to the channel. It will bring you some good luck in your forthcoming exams. So, when preparing books of accounts, we go through an accounting cycle, and with the accounting cycle, it comprises of the occurrence and documentation of transactions, generalizing, posting to ledger accounts, extraction of a trial balance, end of year adjustment, preparation of financial statements. So, having known that, today we are going to be looking at occurrence and documentation of transactions. So, with the occurrence and documentation of transactions, you should get know that once business transactions occur, they are recorded on source documents. The source documents are the source of all information recorded by a business. So, some of the business transactions that may occur include carrying out of sales transactions, carrying out of purchase transactions, receiving or paying money from or to an entity, owing or being owed money, and so on. The source documents used to record these transactions may include, but before we look at some of them, I want you to know that these documents must always be present to support any transaction made. Hence, at times, they are called the supporting documents. So, if a transaction has occurred in accounting, it must be evidenced by some of these supporting documents. So the supporting documents that are commonly used are we have a credit note. Now, most of the students cannot differentiate between a credit note and a debit note. What I want you to know that with the credit note, this is a document sent by a supplier to a customer in respect of the goods returned or overpayments made by the customer. Now, I want you to know that it is a creditor that issues a credit note to data. A creditor can be a supplier and then a customer can be a debtor. So I'm going to go on and explain further. Let me also define the debit note. So the debit note, this is a document sent by a customer to a supplier in respect of the goods returned or overpayments made. So you can see that they both relate with goods returned and also overpayments. But the debit note, it is issued by a customer, that is the debtor, to a creditor. So normally when they are issuing, I want you to know that it is the creditor that issues a credit note. You always get the definition from the word itself. So credit note is issued by a creditor. The creditor is a supplier. So you know that it is the supplier that issues a credit note to who? To the customer who's a debtor. Then the debit note, it is issued by a debtor. It is the debtor that issues a debit note. So this debtor can be a customer. So issues it, it sends it to a supplier who is a creditor. So with issuing, credit note is issued by a creditor who is a supplier. Then with the debit note is issued by a debtor who is a customer. Credit note it is the debtor, and then debit note it is to the supplier. So having known that, I want you to understand that still a customer can issue a debit note to a supplier and also a credit note to a supplier. So let's first look at the debit note. So once the debtor issues a debit note, it is the debtor that issues. Normally, it is the debtor that the customer that issues a debit note to a supplier. What will this mean? It will mean that the customer has debited the supplier or the creditor uh, in their books. They have debited the supplier in their books. So this will show in the books of the customer, this will show a reduction in price. So what does this mean? Remember from Alice, creditors reduced by debiting. So if at all I want to show a reduction in price of the creditor, I'll debit. Hence, I'll be sending a debit note to the supplier. So this is what they mean by this. A customer sending a debit note to a supplier. It only means that the customer has debited the supplier's account. Supplier who's a creditor. And this will be showing a reduction in price. And we know that creditors reduced by debiting from Alice. So having known that, why do you need to show a reduction in price? It's because of purchase returns, when the customer has returned goods back to the supplier. So once this customer returns goods back to the supplier, what we shall call purchase returns, they get to credit the supplier to show that they are reducing the price of the total purchases of the goods they took from the supplier. So because of purchase returns, or it can be when the supplier had overcharged them. A case in point is here. So a debit note is issued to reduce the creditor's account due to an overcharge. So if at all they overcharge them, they want to show that at first they overcharge them and they want to reduce the figure of the supplier. So they will end up passing a debit and hence send a debit note to the supplier to show that they are reducing the actual figure that the supplier is demanding them, which was overcharged. We can go to a case scenario where there's an undercharge. So if at all there's an undercharge, that's when a customer issues a credit note to a supplier. So what does this mean? It means that the customer has credited the supplier's account or the creditor's account. And remember, from Alice, to show an increase in price, a credit increases by crediting. So the creditor's account is increased by crediting. That's why they will issue a credit note. Why? This is the because the supplier had undercharged the customer. So if I told the supplier had undercharged the customer, you end up passing or issuing a credit note to show that you're now increasing the price. Hope that is clear. Then we go to the creditor, who's the supplier. What happens when the supplier issues a credit note? So when a supplier issues a credit note to a customer or the debtor, this simply means that the supplier has credited the customer's or debtor's account. And remember from Alice, uh, debtors reduced by crediting. So this supplier is trying to credit the customer because of the reasons that I've listed here down. That is because there was a sales return, because this customer returned goods back to him or her. So to show a reduction in that price, they're going to issue a credit note, which will show a reduction in price, and we know that data is reduced by crediting. So it is the supplier or the creditor that will issue a credit note to a customer because of sales returns to show that reduction in price, or when the supplier had overcharged the customer. So ideally, a credit note is issued to reduce the debtor's or the customer's account due to an overcharge. That is for this reason. Hope that's clear. Then, when does a supplier issue a debit note to a customer? Now, in case the supplier issues a debit note to a customer, this is what happens. This case scenario, it is for an undercharge. So, meaning that if I told the supplier had undercharged the customer, the supplier has to debit the customer's or the debtor's account to show that there's an increase in price. And you know from Alice, data has increased by debiting. So once you know that data has increased by debiting, the only way the supplier can increase the customer's account is to pass a debit note. Why are they increasing the price? It's because the supplier had undercharged the customer. So the only way to show this is by issuing a debit note to show that they have debited the customer or the debtor's account. Hope that one is also clear. So having known that, that will set out a difference between a credit note and a debit note. So ideally, normally, this document is sent by a supplier, that is the credit note. I told you a creditor stroke supplier sends a credit note to the customer, and then a debtor stroke customer sends a debit note to a supplier. But it does not mean a customer can never send a credit note. It's possible in the case scenario of an undercharge, and also for a supplier it's possible for a supplier to send a debit note in the case scenario of an undercharge. Hope that is clear. We move on to the next source documents. We're having a quotation. Now, for a quotation, this is just a document sent to a customer by a company stating the fixed price that would be charged to produce or deliver goods or services. Then we are having a purchase order. This is a document of the company that details goods or services which the company wishes to purchase from another company. Then we have the sales order. For the sales order, this is a document of the company that details an order placed by a customer for goods or services. So I want you to note that the customer may have sent a purchase order to the company from which the company now will generate a sales order. So you can see that the customer has sent a purchase order when they desire to purchase certain items from a company, and then in return the company, for it will issue a sales order. And by sales order definition, we have looked at it. It's a document of the company that details an order placed by a customer for goods or services. Then we are having goods received note, what you can call GRNs. This lists the goods that a business has received from a supplier. I want you to note that often the accounts department will want to see a relevant GRN and the matching purchase order before making any payments to the supplier's invoice. Later on, we are going to be looking at what is an invoice. Then we are having goods dispatch note. Now, this lists the goods that the supplier has sent out to our customer. Also, I want you to also note that the customer will compare the goods dispatched note to what they received to make sure that all items listed have been delivered and it's matching the right specifications that were indicated on those goods. Then we are having the invoice. So now this invoice, this shows the claim of money regarding goods sold on credit. And with the invoice, there are two types of invoices. We are having the incoming invoice and also the outgoing invoice. Now, what is the difference between these two? The incoming invoice, this is a bill that a business receives from a supplier to request for a payment of goods or services. Now, this is a diagram to illustrate. Now, it is the supplier that sends an invoice to the business. Now, this invoice will be claiming for a certain figure of money that the supplier is demanding the business. I want you to know that this incoming invoice relates to a purchase order. So when a business buys goods or services on credit, it receives an invoice, and this will be an incoming invoice from a supplier. Now, the incoming invoice will show the amount the supplier is claiming to demand the business. Now we are having an outgoing invoice. This is a bill that a business sends to its customers, or you can call them clients, to request for a payment of goods or services provided. Now, this time around, it's the business asking for money from the client, and it sends out an outgoing invoice. So, when you look at my note here, outgoing invoice relates to a sales order. So, earlier on, the customer had made a sales order. So, you find that it's now business sending out an invoice claiming for the goods that were taken by the client. So when a business sells goods or services on credit to a customer, it sends out an invoice, what we call an outgoing invoice. So with this outgoing invoice, it's just a request for the customer to pay what he owes. So having known that and having looked at all these source documents, they're not the only ones. There are other source documents, but I decided to look at these. So you can go on and search about the other source documents. So with that, thank you so much for watching. Make sure you subscribe to the channel.